Hello, my name is Mark Laffaye, and for my senior project, I chose to research which company you should put your money on when it comes to the future of electric vehicles. If you were to invest $20,000 in Tesla the day the first Model S was delivered to a customer back in 2012, you would now have $230,000. This number is especially impressive given that if you had chosen... Sorry, I just drank a soda, and I feel like I have to burp, but if you had chosen to invest in the S&P 500 at the same time, and for the same amount of time, which many consider the best index to represent the US stock market as a whole, you would have only ended up with around $85,000. Everybody likes an extra $150,000, and making the right decision of where to invest is especially important when it comes to a rapidly growing sector such as electric vehicles, where changes are constant. First off, the electric vehicle sector is a classic example of rapid growth, and this becomes apparent when you start looking at the predicted sales numbers of these vehicles in the future. So as you look at this chart, it shows perfectly how this market is just beginning to take off and in a great position for an investment. That arrow is pointed at 2017, but we're actually in 2018, as I'm sure you guys know. But anyways, you can see just how the market's sort of taking off, but it hasn't hit max growth yet. To quote Warren Buffett, most people get interested in something after everyone else already is. The time to get interested is before everyone else. Basically, this market is in a great position to take off, and you want to get in it before it actually does. So during my initial research, I found 4 automakers that I believe have the highest potential for future success on the stock market. The 4 automakers that I chose to research are Tesla, General Motors, Ford Motor Company, and the Volkswagen Group. During this beginning phase of my research, I also came up with 4 criteria that I believe each of these manufacturers must focus on in order to see continued success on the stock market. The most important factor when it comes to success on the stock market is focusing on the investors themselves. Listening to what shareholders want and delivering on your promises is critical to positive stock performance, and if you don't focus on what they want, your share price won't go anywhere, which is the whole point of investing in the first place. Since this is such a huge aspect of deciding where to invest, I put this idea into a category of its own, which I just called shareholder support. The other 3 criteria that I determined were important for success are much more about a manufacturer's specific approach to the electric vehicle market itself, and because of this, I put these criteria together in a category that I just called market success, which is basically just meeting the goals the company has set, current performance in the market, and the ability to succeed in the future. Pulling back to my 3 more specific criteria that are elements of this category, through research I found that in the electric vehicle market specifically, market share, battery cost, and charging were the 3 biggest factors that affect vehicle sales. Focusing in on market share, researchers have determined that market share on its own is even more important than making money when it comes to a new market. Real quick, market share is just what % of the market is controlled by each company. So if Coca-Cola sells 30 out of all 100 cans of soda that are sold, they sell 30% of all sodas and have 30% market share. Going back to my point, what these researchers determined is that getting your vehicles, or really any product sold, as fast as possible is even more important than making money, and the losses you're taking on your cars will pay off massively down the road. This doesn't mean just handing your cars out for free, but is more about turning a blind eye to profitability and just focusing on selling your cars. While this is definitely more of a risky strategy, research conducted by the Harvard Business School way back in the 1970s found this to be true mainly due to something called market power. This researcher determined that a business's ability to earn higher profits than their competitors is more a result of their greater market power versus something like their economies of scale or quality of management. Market power allows for a company to shape that market at its own will, creating exactly what benefits them most and allowing for profitability down the road. This is super interesting because you're taking that risk and turning your focus away from spending and income and all of that and just focusing on moving your product, which is sort of a unique idea in the business world. But it's actually the strategy that most of these manufacturers have adopted. While this strategy applies to all new markets, battery cost and charging definitely don't. They are really important for electric vehicles though, and each will play a major role in the future of the market in my opinion. So battery costs have been steadily dropping for years. In fact, a battery that cost $1,000 in 2010 will cost $109 in 2025 and only $73 by 2030. Obviously, whichever manufacturer is on the forefront of battery development will have a huge advantage in their market as their vehicles become cheaper and cheaper to produce as time goes on. Regarding charging, this is a huge aspect of owning an electric vehicle, and whichever automaker offers the easiest, fastest, and most abundant charging will have a much easier time getting consumers to switch to electric vehicles. So tying this back in, battery cost, charging, and market share are all critical in achieving market success, which is why they stand together in that category. So for my research, the brand I chose to start with is Tesla. It is the most popular electric vehicle manufacturer in the US and is by far the most exposure in the media right now. Moving right into shareholder support, after huge share price gains in 2013 and again in 2017, the growth has slowed down for now. Tesla's price is also notoriously volatile, constantly moving up and down with every bit of information released by the company. This seems to point to a very mixed support and a growing lack of faith in the company as investors start to really focus on Tesla's plans for the future more than ever. In terms of their performance in the electric vehicle market itself, Tesla is in a great position though. Currently, they have by far the highest market share at 45%, which is great for when the time comes to make that switch to focus on profitability. In terms of battery development, Tesla also produces lithium-ion energy storage systems and solar roof systems in addition to their cars, which is a definite positive for being on the leading edge of battery development, which is again a huge advantage for the company. Looking at charging networks, Tesla has its own independent charging network containing 1,130 stations with around 8,500 independent chargers in North America alone. The supercharger network is the largest of its kind and is currently only open to Tesla owners. Okay, a very important negative to know with Tesla is their cash flow, however. Looking at this chart, you can see just how dramatically their spending has been increasing in recent years, starting in about 2014. This is mainly due to their production issues with the Model 3, which is costing them a bunch of money as they try to retool their plants and everything. But anyways, this has caused serious cash flow issues for the company, and just recently this forced them to dip into junk bond offerings, which is highly unique given their large size. So, simply put, bonds, at least just corporate ones, are where an investor hands money over to a company in a form that's like a loan to be paid back at a later date with interest. And junk bonds are loans available to investors that fall below what's called investment grade. So basically they're just the riskiest bonds available since the future of the company, in this case Tesla, is clouded. And they've been forced to take this approach to get money after their cash flow has sort of dove down in recent years. So going back to my chart here, this leads to Tesla being in a rather risky position. It has the sales numbers to facilitate major growth, is at the forefront of battery development, and is the only automaker with an independent supercharger network. But at the same time, they're running into financial struggles, and that could lead to a collapse in the future. So I placed it just barely in the upper right box there, with the left to right coming from that mixed shareholder support I mentioned earlier, and their questionable market success due to the uncertainty of their future. So the next brand that I looked at during my research was General Motors. Right off the bat, the massive size of the company makes its failure unlikely. As Kyle pointed out to me during my research, the financial crisis in the late 2000s was a worst case scenario for the company and put them on the brink of bankruptcy, but the government actually stepped in and saved the company through bailouts topping $10 billion. So this was as bad as it could get for the company, and seeing as the government stepped in to save it, realistically there's no risk of a GM collapse at this point. So focusing in on their electric vehicles, GM has taken a more traditional strategy when it comes to their introduction, and that strategy is leading to moderate success. In terms of shareholder support, General Motors has seen success on the stock market recently, with their share price increasing by 22% over the last year, which does show considerable shareholder support in their future. In the electric vehicle market specifically, while GM does not sell as many pure electric vehicles as Tesla, it is their largest competition right now at 16% market share. As a large company, GM is in a great position where all it needs to do in order to achieve long-term success is just push its vehicles into the consumer spotlight and they're able to ignore profitability for the time being. So moving on to battery production, their capabilities are very limited compared to Tesla, as you would expect. And while this does raise some concern, they have announced some plans on organizing with more suppliers through China and stuff like that. So they do have some plans, which is more than what most automakers have right now. Moving into charging, GM is currently reliant on public charging stations and has no independent network like Tesla, which is definitely a critical concern of potential EV buyers down the road. So rolling into my chart again, I have come to the conclusion that while GM has a lower market share than Tesla, it is a strong competitor in terms of sales, has the trust of Wall Street, and has the financial ability to produce vehicles at a loss for years to come, which puts it in a great position high up in that top right corner there, with their strong shareholder support and a considerable chance of success down the road. So the next company that I researched was Ford Motor Company. Ford is just starting to jump into the electric vehicle market, but there are a couple of important things to note before investing. While Ford as a brand sells the most vehicles in the US every year, its share price has been declining consistently for the past decade. Its price per share has fallen 42.7% since 2011, which is really just awful performance. And focusing specifically on electric vehicles, they only have 2% market share right now. Just this January, however, they announced a planned investment into electric vehicles of up to $11 billion in research and development by 2022, but they are getting into the game a little late compared to their competition. In terms of battery cost, Ford has not announced anything, and it's a similar story with charging network plans. So both of those last points I mentioned are important to focus on, but Ford has not announced anything notable in regards to either one, but putting them in a pretty rough spot as we go into my chart again, where I put them in the bottom left box. Shareholder support is really non-existent at this point, and given the lack of models and their small market share, success selling electric vehicles is questionable for the time being. So lastly, I looked at the Volkswagen Group. Overall, it is in a somewhat similar position to Ford, although it is a little bit different. So shareholders have serious issues with the company as a result of the ongoing Dieselgate scandal. The current price is still far below where it was before the scandal. I don't have the exact numbers, but I think it's around like 65% of where it was before the scandal broke. So they're still far from recovery when it comes to their share price. While Volkswagen is running into serious problems of trust, just like Ford, as one of the world's largest automaker conglomerates, the company has been able to pledge $40 billion towards research and development by 2023, which is a good sign for the future of the company when it comes to selling cars successfully. Similarly to Ford, no solid plans for charging networks have been announced, but unlike Ford, Volkswagen has pledged $60 billion towards battery production by 2030. This leaves the Volkswagen Group with a considerable chance of selling models successfully in the future, but due to a serious lack of trust from investors, it is unlikely to see huge success on the stock market, which is really the whole point of investing. While it has pledged a lot of money, currently Volkswagen only has 2 electric vehicle models for sale, and neither is on the level of success attained by GM and Tesla, only achieving 4% market share. So for Volkswagen's chart, I put them in the top left, where they have a very high chance of successfully selling electric vehicles down the road due to those large investments, but the shareholder support is not there and probably won't be for a while. So based off of this research of mine, I have chosen 2 brands that I think are in the best positions for success in the future from an investor's point of view, and the first brand that I picked would be Tesla. As a manufacturer in the spotlight right now, Tesla has done very well on the stock market through their massive share price gains, and on top of that, they have the best market share by far at 45%. These huge advantages combined are a strong counter against the more recent cash flow issues they've been running into and their current lack of profitability. Tesla is currently dominant in battery production and charging networks, and these advantages will allow for continued success if they can just work out those cash flow issues. These issues still make Tesla's future clouded, however, and the long-term success of the company has been called into question many times for good reason. The other manufacturer that really stood out in my research was General Motors. The ability to afford losses on electric vehicles for years with almost no consequences, their huge size, and their decent Wall Street support makes it a very solid and safe investment. This reveals a major difference between Tesla and GM that is important to note, however. As Tesla is highly dependent on its electric vehicles as their main products, these cars heavily affect their overall success. GM is a large traditional automaker with only a relatively small electric vehicle division within that company, so the growth of that electric vehicle division will not have as drastic effect on their share price when compared to Tesla, where the majority of the company is again dedicated to their electric vehicles. This means GM won't be able to achieve the same growth as Tesla might, but as I mentioned earlier, this is countered by their collapse being seemingly impossible, so your investment is very safe. Overall, I believe that Tesla provides for a risky investment, but has the opportunity for massive growth. On the other hand of the spectrum, General Motors represents a lower yield investment, but with very safe returns. Both investment strategies have pros and cons, and either investment is a solid choice if you know what you're getting into and aren't afraid of a little bit of risk. Thank you for listening to my TED Talk.